Good morning, Jason.
Good morning.
Good morning.
Hello?
Hello.
So,
Good morning.
Hello.
morning.
Hey.
It's a real talkative group this morning.
Bill, are you going to need to share your screen? And Brian, will that be possible?
Yes, we can make that happen. That's who needs to share?
I'm not sure.
No, you're on mute.
All right, I'm not now, right?
Yep.
Let me try it, just see what happens. Oh, it says host has disabled screen sharing.
Come on, host. Gotta share now.
Okay, you should be able to now.
How's that?
Got it.
Got it.
Oh, there we go. Perfect.
Hey, Bill, Scott here. When you get started, could you give us just kind of basic 101? I know I kind of forget from year to year some of the terminology. I know we have some new people, especially rates and how you use that term would be good to explain.
Sure.
Thanks.
We're just waiting for one more.
Jason?
Yeah, I think we're ready.
All right, good. I'm still learning how to use this thing.
Morning,
You
David.
got it.
Morning.
All right, I guess I'll call this meeting to order of the Retirement Commission. The only item on this morning's agenda is a report from the plan's actuary, Sageview. They do an experience study every 5 years that sort of goes over the assumptions that the plan uses in calculating what the contribution rate should be. So I will turn it over to Bill Dowd, and I think he's going to explain a little bit more about this process and walk us through the experience study.
Okay, thanks, Jason. Can everybody hear me and see the screen?
Mm-hmm.
Yep.
Yes.
I've got two of my associates on as well, Bill Reed and Dan Homan. Bill's been, you've met Bill lots of occasions in the past over the years. Dan, I don't know if you've ever met in person, but he's been working with us for quite a while now and is really responsible for the OPEB valuation, the post-retirement healthcare evaluation. So they're both on the call here. Well, I'm sure they'll pipe in periodically as I try to stay on course here. If you have questions, please, flag me down or find some way to raise your hand and we'll try to address those. But I'm going to move into, the reason we do this. We do evaluation, first of all, for getting the experience study. We do evaluation every year for the retirement plan, for both the pension and OPEB plan for a lot of different reasons, okay? We do it in order to produce information for the city's financial statements, to put information in the CAFR as far as funded status and composition and expense and things like that. And we also do it in order to determine the funded status and requirements for additional funding going forward in terms of contributions to keep the plan, solvent over time. And when we do the valuation, we do one each year at July 1 or as of June 30, whatever. And we come up with a lot of information as to funding and contribution requirements and everything else. When we do that valuation, one of the things we do is develop a contribution rate, which we then actually break down between the various entities and groups in terms of general employees, public safety employees, and the one participating employer that has a rate is the library. And those rates, when we develop them in July of this year, as of July 1, they'll actually go into the budget process for the fiscal year that begins in 2021. Okay, so it's like a 1-year lag because we don't really finish the valuation until sometime in September, October. We have to get year-end census information and asset information and everything else. So we usually meet with the Retirement Commission in October each year to present the valuation results. And then some of that information goes in the CAFR next year. Some of it's used for the 21-22 fiscal year budget, okay, as far as contribution rates go. So one of the things that you're required to do by city code, and it's also just good practice, is to do an experience study, because in doing that valuation, we make lots of assumptions about what things are going to do in the future in terms of both demographic things and economic occurrences. And we'll talk in depth about those. But so every 5 years, we take a look at the assumptions we've made for the last 5 years in lots of different categories, compare it to what's actually happened. And if we think we're a little bit off track or a lot off track, we'll make recommendations to change some of those assumptions, okay? So that's what we've just done. We've just taken the data for the 5 years ending June 30 of 19, run through an analysis of all those assumptions versus the actual experience, came up with some recommendations, so things we think we should change. We also spoke with both Jason and Sarah to try to get some input on a couple of variables going forward, especially the salary increase assumption, because I know you all, you've made some changes in your compensation programs over the last several years, which actually have led to higher increases in pay for a lot of folks than we had been projecting. But some of the dust has probably settled on that, and it may not occur again. So, when we looked at the actual experience of 5 years, we wanted to get a feel for whether or not we thought that was going to continue. So we'll talk a little bit more about that. And then the last thing, which we really think is between you and your investment advisor, people that actually manage your fund, is the long-term expected rate of return on the assets. And we'll talk about that. And we'll show you the impact of changing that expected rate of return 25 basis points. But I think, you probably need to have a further conversation with the folks that are actually helping you manage the funds before you decide to make that kind of change. Because, if you change the assumed rate of return going forward on assets, it has a significant impact on the liabilities, funded status, and required contributions, okay? Whatever changes you decide to adopt, I'm thinking you might adopt some of them today. We certainly need some guidance as to how to do the July 1, 2020 valuation, right? Which we'll start working on probably in August. So, you know, we'll talk about things today. Anything you adopt will go into effect that valuation, and it'll affect the following fiscal year, not the current fiscal year that's starting in July. Okay, and this applies to both pension and post-retirement healthcare. So with that said, you've got a very lengthy report. There are 47 slides. I really hope I don't have to go through every one of those, because that'll be like torture, I'm sure. So we'll try to hit the high points, and then if we need to jump to the back where we have lots of charts and graphs, we can do that. Questions, comments? Bill, Dan, you got anything to add to that?
Carry on.
Carry on. Okay. Let's see. So here's a high-level summary of the recommendations without a lot of the numbers. For some of the demographic assumptions, we're recommending changes. Things like retirement rates, when we think people are going to retire, at what ages. The last 5 years, people have retired earlier than we've assumed they were going to retire, both public safety and general. So we're recommending some changes to our assumptions as to when people might retire going forward. We've had more terminations from employment before retirement than we expected. So we're recommending some changes in those rates as well. We've got fewer people covering their spouses for their health care in retirement than we expected. So we're going to reduce that, or recommend reducing that assumption. You know, people are living longer in general. We updated the mortality table, the last experience study, and we're recommending another update this time. We'll talk some about that. And then we've got some slight changes to, like, the differences in ages for spouses and how many people actually elect to take the health care when they retire, because they do have to pay for part of that. But those are not really material changes. And when it comes to spouses, we know for active employees, we don't know if they're married, and we don't know how old their spouse is. So we have to make some assumptions as to that. So we're going to change those, tweak those a little bit. As far as the economic assumptions go,
Bill?
the last 5 years, the increases have been significantly higher than our assumed rates, but we've pretty much been told that that's not going to continue into the future, because there were some comp plan changes in the last 5 years. I mean, and there's pretty much no way, you know, you could continue some of the increases you've made, because they were just adjustments. Maybe you did comp studies or whatever, or comparability studies. I'm not really sure.
Hey,
So
Bill.
we're recommending a slight increase in our salary increase assumption going forward, but nothing like the last 5 years experience. About 50
I have a
basis.
question, Bill.
Yep.
Go ahead. I thought we had a question. I guess we don't.
Well, I have a question.
Yeah. Yeah.
So, if it's people are living longer, update mortality tables, which is true, but we have a very unique thing going on, and I've seen statistical pictures of what's happening now, which is changing mortality in a fairly noticeable way.
Yeah, potentially, yeah. I should have put a big red, one of those big red circles on the front of this with the line through it that said all of this. Nobody knows what the impact of the pandemic is going to be on exactly what you said, on economic conditions, on the city's ability to pay, on investment returns. Because that's a whole wild card out there that, you know, I don't think anybody has the answer to. But you're right, at least in the short run, there's going to be a definite spike in mortality. There already has been, right? How much of that affects the city of Charlottesville, who knows? But yeah, and is it going to have a long-term effect on mortality? Yeah, potentially it could. The good thing is a lot of these mortality tables are updated now every year based on recent experience. So in theory, we've got projection scales in the mortality tables that change every year. So we'd like to think that if things really start moving in the other direction, that won't be 5 years before we start recognizing some of that. Okay, but that's a good question. And I don't think anybody has the answer, unfortunately.
Right.
Economic assumptions, like the salaries, I said one thing. The investment returns, again, yes, they've met expectations. Of course, yeah, the year ending June 30, 20, maybe you'll make 7.5, but I if I'm a betting man, I'm saying you're probably not going to have a 7.5% return, right? When I'm seeing what year to date for 7/1 to June, yesterday plans are probably up. They're probably not negative like they might have been a couple months ago, but they're probably nowhere near 7.5%. So my guess is you can have a loss versus your assumption this year, but this is a long-term proposition, right? It's not a one-year proposition. A couple of years ago, you had negative returns, and then you've had double-digit returns. So unfortunately, year end in 2020 is probably not going to be good. Doesn't mean you'll be worse than your peers. You may be better than your peers. So the question is, do we assume that we're going to get 7.5% going forward now that we've already taken the hit? Or do you think there's some reason to lower that assumption? We'll talk more about that. I've got some data on that. Because if you lower that assumption, that increases the liability value, and it requires the city to fund more, or the employees to fund more. It also lowers the funded ratio. Okay, doesn't mean you shouldn't do it if you think it's the right answer. But again, some of that's quite a wild card too. And we've got some reduction in what we think are going to be the future increases in medical and dental trend, because we project healthcare benefits going into the future in order to value the OPEB plans. And we're seeing slightly lower costs in that regard. Now, this pandemic, this is going to be an interesting thing because we've had a lot of medical claims this year based on COVID-related illnesses. But we've also had an awful lot of things not happening because people are not having elective surgeries and other treatments. So, it's kind of hard to tell if you're ending June 30, what kind of experience your health plan has actually run. Because you picked up claims in one area and you've probably lost claims in another area. And the net effect, I'm not really sure. So again, is that going to be a long-term trend? Probably not. We might always end up treating COVID-related illnesses, but people are not going to defer having other things done forever, even though they have for the last several months. Okay, so you put all that together. Other things we look at are methodology. Okay, a couple of things I wanted to talk about. One is the fact that when we develop the contribution rate on the pension plan, we actually smooth gains and losses above or below our assumed rate of return over a 5-year period. Okay, we're recommending we continue to do that. What we've done, I think the last time we did an experience study, we kind of marked the assets to market and then started smoothing gains and losses going forward. If we did that June 30, we'd probably end up marking assets at a lower number because of this year not being a good year. And we don't see any reason to do that and artificially raise contribution rates. So we're recommending just continue the 5-year smoothing that we've been into, and we'll smooth whatever happens this year over a 5-year period. The same thing with the unfunded liability. One of the things you're trying to do is improve the funded status of this plan over time. And back in 2015, when we did the last study, you adopted a 20-year amortization of the unfunded liability for pension and a 25-year amortization for OPEB, which means there's 15 years left to amortize on pension, 20 years left on OPEB. We don't really recommend at this point extending that to a longer period. Be like refinancing your house. You get down to 15 years and you go back and get a 20-year mortgage. So we did some cost calculations for all the recommendations, assuming that what started as 20 and is down as 15 would continue to be amortized at the 15-year rate. Okay. What started at 25 for OPEB is down to 20, would continue on to 20 years. So the mortgage isn't getting longer, just might be a little bit bigger amount or smaller amount, depending on what assumptions we change. I guess we could always discuss that. And that's also one of the things that if you decided, for example, to reduce the long-term rate of return assumption, that would increase your cost. You might, if you did that, which is a little bit of a conservative move, you could potentially extend the amortization period a little bit to get contributions back to the more affordable level. But we didn't do numbers that way. We just showed you numbers as if you stick with 15 and 20 years. Okay.
Bill,
Yep.
on the smoothing, is there a material difference between, say, a 5 and a 10-year period?
Well, it really depends on what happens. You
Okay.
know, in the period, how dramatic the swings are. You know, we don't smooth anybody over 5 years. We
Okay.
think that's getting to the point where you're almost not even paying attention to market value. The other thing is we do have a corridor around how far we let it stray. So if the market really goes way up or way down, we're not going to let the smooth value, you know, be 30% different from market, because that would be kind of, you know, not very responsible to do that. But I think, you know, and most actuaries will say the smoothing should be 5 years or less, although there are some large systems out there that use longer smoothing. So this is what happens. We actually show on page 6, 2 years of prior results, the 2018 valuation, the 2019 valuation, which we're not going to change, okay? And then what happens in 2019 to those numbers if we make the recommended changes, and then what happens if we also change the discount rate to 7.25 from 7.5, okay? So you can see the pension at 2019 was 58% funded. OPEB was 56% funded. Overall, about a 58% funded ratio for all these retirement programs, okay? If we change the assumptions, all of the assumptions that we're recommending, the pension funded status actually drops 2%, okay? The OPEB funded status actually goes up about 3.5%. So the net impact on the city, the overall balance sheet, is a slight reduction, but it's not a huge reduction, okay? If we then change the discount rate though, then the funded status drops on both plans because the liability number goes up. I mean, it's not a huge drop. It's you know, 1.5% overall, but you know, it still is a drop, and that is dollars. And I'll show you the dollars in a minute. So again, this is what 2019 showed. We're really not going to change that. All of this is saying, if we had made these changes for that valuation, this would be the impact, which means if we do it this year, it's going to have a similar impact. The problem with this year is on the pension and OPEB, if the market really has not performed and you end up with a 2% return, chances are all these numbers are going to be lower. The relative values are going to be the same, but what might have been 56%, you know, might now be 52%, right? And the 54 may be 50. But you know, I don't know what the market value is as of May 31, but I can't imagine it's up 7.5%. Okay.
Hey, Bill.
So we're probably looking at worse numbers. This just shows you the difference affected by these changes.
Hey, Bill, Scott here. Got a quick question.
Yep.
On the 2019 no changes, the orange bar,
Yeah.
did the 58.3, 56.5, and 57.8 hit our targets?
I almost have to go back and look at the Val report to see. Yeah, it's interesting. Back in 2016, you did a bunch of work in like 2015 time period. We had a study, we had a task force, all kinds of things, right? Made a lot of changes. The funded status was 50%. Okay, so 3 years later it was 58. So I don't have the whole glide path we were looking at, but I think that was pretty close to where you thought you'd be. The problem is going to be this year is the market's going to undo that problem. And then if you change your assumed rate of return, that's gonna make it worse. And I'm not saying you have to do that. I'm just saying that it would make it worse. So I'm guessing up until this year, until the pandemic, you were probably on target. Unfortunately, you're probably gonna miss that, and so is everybody else. All right, you're not gonna be the only one. Not that there's misery. I guess there's misery in company loves company or whatever. But so anyway, the impact of the recommendations really between the second and third line is not, you know, pensions down, OPEB's up. Overall, it's not a big deal. If you change the discount rate, it's still not really that much. and it gives you a rate that's more close to the median of public plans, and we'll talk about that in a couple of minutes. When you look at the dollars, the unfunded liability, which is called the net pension or OPEB liability on your city CAFRA, at 2019 it was 83 million for pension, or 84 million. So the change really is worth about $7 or $8 million. Okay, the OPEB though is 4 million, 4.5 the other direction. So what was 118 would become 121, and if you change the discount rate, it becomes 129. So it's about $11 million difference between what the numbers were, which will be reported because we're not changing them, okay, to what they would have been had you changed the discount rate or had you not changed the discount rate. Here, it's about what, $3 million difference, a little less than 3 million, which in the overall balance sheet of the city probably isn't that big a number. But again, these numbers are probably all going to be bigger this year because of the investment performance. Okay, and the refunded ratio is just, you know, based on these numbers. One great story you have to tell is your OPEB funded status. I don't have another public plan that's 50% funded for OPEB. Okay, most of them are 0, maybe 10, 20 if they started funding. But I don't have anybody that's 50%. So for ratings and you know, and things like that, that's a great story. And then when it comes to the actuarially determined contribution, again, this is the dollar amount, which we then we calculate a payroll amount, and then you apply it to payroll, and that's how you collect it. But the dollar amounts for the 2019 valuation were 9.5 million, 3.7 million, total of 13.2. If we change to the recommendations, pension goes up, OPEB goes down. The net difference is about $200,000. Okay. If we change the discount rate, it's another $600,000. Okay. So where you were to the worst case on this example is about an $800,000 difference. Now, again, these numbers may look a little bit worse when we do the 20 val because of the investment performance. Okay. So that's sort of high level budget dollars. And then what we did on the next slide is translate those into percentage of pay, pension and OPEB, the pension contribution rate. And this is the rate that's going to be used for the 2020, the budget that starts next week, right? 2483 for pension, 9.4 for OPEB, total of 34.2. Had you changed these assumptions a year ago, the pension would have gone up, OPEB would have gone down, and the net impact was about 50 basis points total cost, okay? Which translates to that couple $100,000. And then if you were to change the discount rate, it goes from a total of 34 to 36, so 2.4%. That's assuming you stick with the same amortization period, 15 on pension, 20 on OPEB. You decide to go a little bit longer, you probably could get back to where you were. We almost feel like, you know, if you do anything today, maybe you make some decisions on the assumptions, and then we kind of look at the valuation results June 30, when we get the new asset information, especially. And then, you know, if you want to revisit the amortization, you certainly could. You know, 20 years or less is very conservative. You know, there are lots of plans that are 30 years amortization, but we know what you're trying to do here. You're trying to cover the gap as soon as possible. So we're not really recommending you lengthen the period. The only question is, if you do a June 30, 20 valuation and you want to change to 7.25, and this 36 ends up being 40, can you really afford it? Whereas you could lengthen the amortization period a couple of years and still be well within the range of what people think is reasonable. You know, you might want to consider that, but I'm not recommending that. I'm just saying that that's out there. So this is the net impact in terms of contributions. And again, the worst difference here, going back to the prior page, is about an $800,000 budget difference. And Jason, correct me if I'm wrong, I know this year you actually funded excess of the required anyway, right? Because you were doing some pay adjustments.
Yeah, we at year end, we made an extra contribution to cover those one-time salary increases that you were talking about that happened a year or two ago.
And how much was that extra contribution?
I think it was close, was it, Chrissy, was it close to 1.8?
1.8.
Yeah. So again, you've done that other times in the past. You've actually done things like that too. So I don't know, if you end up with a $500,000 more in contributions, is that something that the city can afford? Of course, all these other pandemic related issues as to revenues and everything else probably coming into that equation. So maybe the answer is we don't know yet.
Hey,
Bill?
Jason. Also, I know that the commission recommended a rate that was different. And so is that for 19, it was the recommended rate that we used, right? But for 20, was it different, or am I
Yeah.
getting these years confused?
That's for 21.
Okay.
Yeah, so none of this would be affected by the adopted rate for 21.
Okay. Because I'm trying to find it now, but I'm getting the years confused.
Yeah, if you're using a different rate than these, Jason, for the budget that starts next week.
The blended rate is slightly higher than, because the OPEB rate was going down, and we elected to take that difference and put it into the pension plan for FY21.
Okay.
So you're not going to see that for another year, but we are going to be contributing slightly more than what was recommended last year.
What are these contribution rates of? A percentage of what?
Payroll. Every pay period, they're calculated based on the employee pay, and then they're made a contribution to the trust.
And this is regardless of who's making that contribution?
This is a city contribution.
The city.
Yes. The employees, they make their own contributions depending on when they were hired, what plan they're in, et cetera. That's on top of this.
So if somebody's paid $1, the city kicks in about 35 cents?
Yeah.
And that's the blended rate for general and public safety?
Correct. Yeah, and they're different. Yeah, we split this out by the groups. We didn't do it for this exercise, but you're right. This is the blended rate for both, but there are different rates for public safety.
And this includes or excludes the library?
It includes the library as well, which will break out a separate rate, and there's a small piece.
So it wouldn't be quite 800,000 for the general fund then?
Correct.
For the city?
Yeah, that's true.
Okay.
Okay.
On OPEB, you said there's no plan that you work with that has anything like this. That we're
No.
good. If it's 0 is common and
Right.
we are what we are, at what point are we still good, but less?
I think sticking with your strategy of funding OPEB, the full actuarially determined contribution, is really the story. Because you're doing that, the result is a 50-60% funded status or 56% funded status, right? If you were to change and say, we're no longer going to fund that, right? We're good with this and we'll let it decline over time and then we'll catch up later, then that becomes a bad story, right? So I don't think it's really the magnitude of the funded ratio that's the issue on OPEB. The fact that you're even doing it in advance is, I don't know what percentage of public plans have any assets toward OPEB, but it's not a high percentage. So I think you're an outlier in fact that you're funding it this aggressively, which helps your fiscal story.
Hey, Bill, just one other comment on the OPEB. This plan is not a vested benefit. So at any time, the city could say, hey, we're going to cut the benefits, and you're allowed to do that, unlike the pension plan. On the pension plan, once you have something accrued, it's there. Plus, in order to change the future, you've got to jump through hoops. So on the OPEB plan, you could impact the liabilities by changing plan design because it's not a vested benefit. So that's the other thing on the OPEB.
Bill, can you use?
Is OPEB funded at all differently than the pension side? Or is it all kind of the same pot of money? just separated out differently.
It's invested similarly, right, Jason?
Yeah, it's all commingled on the investment side.
Yeah, annually, we allocate the assets based on the payments and contributions. And so the earnings are on the total, but then we allocate based on the individual benefit payments versus premiums versus expenses. So it is commingled for investment purposes.
Okay. The reason I was asking the question about OPEB is it better to have a higher percentage funded for the pension side than to have a higher percentage funded for the other side?
I'm not sure it really makes a difference because the unfunded total is what hits the books. So if your pension plan is funded at 100%, but your OPEB is 0, you still got an unfunded on the books.
Okay.
Yeah,
So
I mean, I would just add, it's not a good thing to be have an unfunded OPEB. The fact that people don't is simply a budgeting issue that localities, have not been able to do that because they're funding their OPEB. We just got ahead of the game early on, in doing that. So it's not a good thing to be in a crowd that's not funded. Right. So while it's a good thing that we are funded, it's still, to your point, a liability that has to be paid.
I guess purely from a financial standpoint, it doesn't really matter where the liability is, if it's in the pension or the OPEB, but certainly the pension rate gets a lot more publicity. People are much more aware of the pension funding than the OPEB, partly because they don't understand what the OPEB benefit is. Bill, I was going to ask earlier, I don't know if you could speak to, I know you mentioned that the funding on the OPEB was a bit of an outlier on the good side, but the proportion of our liability between pension and OPEB, I kind of got the sense that a lot of plans don't have as large a liability on the OPEB side. Is that maybe why we decided to fund it, because we're offering a higher medical benefit than other plans do?
Well, yeah, I think, again, I don't have survey data at my fingertips, but and Dan, you can comment on this. I think your OPEB benefit, especially for some of your original tiers of employees, is a more generous benefit than a lot of your, other localities.
Yeah, I agree. Really the big thing is, once again, in the state of Virginia, I would say most of your localities only provide coverage to age 65. So they're required by Virginia law to offer a program for their retirees before age 65. So, you guys are more generous in that. And once again, I go back to this, because OPEB plans are not vested, the city could change what they offer to impact the OPEB liabilities much easier than they can on the pension side. So that is an option somewhere down the road if that becomes an issue.
And also because, the state law requires you to allow people to have coverage up to age 65, it doesn't mean you have to pay for it. Right? You could provide access at full cost to the retiree, which obviously you don't do that, but you could. There's a pretty big gap, but I think you decided you wanted to stick with an OPEB benefit similar to what you've got in place. And if you're going to do that, it's pretty responsible fiscally to advance fund it, or otherwise your pay-as-you-go costs are going to continue to escalate every year. And more people on the plan, more benefits, more premiums, and everything as people age, and then it becomes a real your budget issue. I think that, you took a similar tack on the pension. A couple of years ago, I think the last experience study, we looked at the cost of living adjustments you were providing under the pension, right? And under the accounting rules, the GASB rules, if you have an automatic COLA, you're required to include the liability for that in your liability for your pension plan. You don't have an automatic COLA, but you pretty much grant one every time you give a wage increase. So you decided to put in an assumption that we're going to grant COLAs in the future and start funding them in advance. Again, it was a prudent strategy. It wasn't really required, But at the end of the day, if you're going to continue to do that, you eventually have to pay for it. It's cheaper to pay for it over time than it is to pay for it all at the back end. And lastly, the last thing I'll talk about that you do well is when you did this big analysis, changed some plan design, changed the contribution structures, you know, the additional contributions employees are making that they didn't used to make, we don't net that away from what the city has to make, okay? Because that was part of the big selling point, especially to your employees, that, you know, we're going to raise your cost, but we're not going to do that so the city can pay less, right? Most employers, if they shift cost to the employees, that means they take it away from themselves. But you didn't do that because the ultimate goal here was to get this thing to 70, 80, 90% funded over a reasonable period of time. So all if you do is swap the contribution from employer to employee, it doesn't help that. So that was another big thing that you can talk about when you're talking to, you know, ratings people and things like that, that a lot of other folks don't do. I'm sure you do hopefully make that comment. So let's see, where were we? Contribution rates. And the rest of this report just gets into all the details of how we looked at every assumption. Now, you've got a copy of this. Let me see, I'm gonna flip through it here. You know, all these retirement rates, we talked about changing various things, demographic assumptions, mortality. I mean, we can get into the guts of this if you want to. On the mortality, we actually finally got, after years of talk, last year we released some mortality tables specific to public sector employee retirement plans. Never had those before. They were all general population type mortality tables. So when we got those, we actually feel like we need to adopt the public mortality tables. Now, they're not a lot more costly than the table you were using, but our fear was that if we don't adopt them, that some auditor is going to look at your financials and say, what would the number be if you use this new mortality table? You know, because they're going to probably want us to do that. So we just went ahead and adopted them. It made a 1% or difference in the liability or something like that. It wasn't huge, but at least now you're using the most recent mortality table specific to public sector employees. And there are different tables for general employees, public safety employees. There are also different tables for people who are actively employed, disabled, retired. We just went with the whole lot. Because a group your size, you don't have enough people to be credible in terms of what your future mortality is going to be, why it's going to be different from the rest of the world. You know, it takes millions of lives over lots of years to look at those kinds of trends. So anyway, we think no one can say you're artificially understating or overstating your liability because you're using an outdated mortality table.
Hey, Bill, it's Chris Cullinan. Could you describe just briefly sort of the difference between the public sector mortality tables and the general population? Just 2 or 3 bullet points of what the differences are.
Okay, well, I mean, when they look at data for general population versus public, I think, and Bill and Dan, correct me if I'm wrong, I think the analysis was that the public total data set for the public employees had a little bit worse mortality experience than for the general population overall.
Correct.
And now you actually have public safety tables, which have different mortality experience than normal general employees. This is the first time we've had a significant study on that. So again, over the next 5 years, we'll look and see what your experience is, how many people have died versus how many we expected to die based on these new tables. At some point we may have to tweak what we're using, but again, it's kind of hard to do that with a group this size when you don't expect to have, nor do you have that many deaths in a 5-year period.
So you're saying there's actually a public safety mortality table. So you apply that to our public safety employee population? Okay.
Yep.
And we've never had that before.
We never had that before. And to be honest with you, there are also different breaks of the table based on wages and benefits, and they have below median, median, and above median. And we looked at your demographics and your salaries and your retirement benefits. And we felt like it was probably somewhere these are national averages, okay? Somewhere between median and below median. So, and of course, higher income leads to, in general, better mortality experience. You live longer if you've got better means. So, rather than try to argue for the below median table, we just opted to go with the median table because, I think we felt like that was, if anything, a little bit more conservative. And you got to be careful about that too, because, this includes, large cities and counties, in addition to places like Charlottesville in that median, that compensation table. So we pretty much use the middle of the road table, but separate for public and general, public safety and general employees. I'm trying to think what else. I was going to go to the, we're not going to change our inflation assumption. We think 2%, who knows? Could end up being 10% 2 years from now, but right now we think 2 is still good. The COLA, we've been assuming at 1%. We left that at that. On the investment return, there's a chart we pulled from last year's December NASRA public fund survey, state retirement associations, shows the median long-term rate of return was 7.25. I think it was 7.3 something the year before. So that's been declining. You're at 7.5, which is not way above median, but it's a little bit above median. And then, and here are your 1, 3, and 5 year returns as of last year. Okay, as of this year, they're probably going to look worse, especially the 1 year. But, we're assuming 7.5, 3 years, it was 10. 1 year was 8, 5 year was 6, and 7.75. My guess is all these numbers come down a little bit this year. So the question is it still reasonable to use a 7.5? Again, I think that's something you probably need to discuss with your advisor. You're 65% equity, 20% fixed income, and 15% real estate. I think that's what you were at the beginning of the year. Of course, everybody's saying real estate's going to get hammered going forward because of commercial real estate issues, with the pandemic and they work from home, et cetera. I don't know if you're still invested 15% real estate. You may have changed that already. But using a capital market assumptions at the beginning of last year, it wouldn't be unreasonable to assume a 7% rate of return for the indexes themselves. And then if you have active management, which you do, you can add some value. You could argue that 7.5 was okay. The question is, do you still think it's okay? And again, you saw the impact if you lowered yourself to the median. I mean, it is a drop in funded status. It is an increase in contributions. It's not an enormous change, but it is, a negative impact.
Jason?
Yes.
So I have a question for you. That information that you sent out yesterday that I commented on about asset allocation and the different levels of conservative, aggressive, I thought was pretty interesting. And looking at ours, it's a little different than what appeared to have outperformed over really all of the periods of time there. Is there any point in talking about that at some point? Not now, but.
Yeah, I think probably the opportunity to have this particular discussion would be with DAHAB when we do the annual review.
Yeah, I figured. Okay.
I think the other thing to just remind everybody of is that we are having a conversation about ESG and its role in our investment decisions. And I know it's been put on the back burner here for a few months, but at some point we're going to need to revisit that. So I think that's also part of the discussion as well, just in terms of overall investment philosophy and assumptions. So I just wanted to remind everybody of that.
Can we go back one slide? So, I mean, it looks like, the big bullet on payroll growth, you're saying that there are no changes, but the one above that, can you explain the scaled down salary
Yeah,
increases?
let me show you the chart. Yeah, and by the way, these are the graphs where we compare what happened to what we expected and then throw in a recommendation. But salary increases, this is what we were using. For young employees, we were using 5% for a certain age, down 4, 3, down to 2. Okay, as you got older, you tend to get more just inflationary adjustments, not promotions and things like that. The actual experience has been a lot higher than that for the last 5 years. So we just put in an extra 50 basis points at each of the age bands. Public safety, we had been assuming 3. I think they'd averaged over the last 5 years close to 5. And maybe some of that happened all at once, I don't know. So we inflated that a little bit going forward, which is high. We're assuming 2% inflation. So these are all a little bit higher than inflation until you get closer to the cap years. But so that's what we built into our model. I mean, obviously, more about what you're going to offer as salaries going forward than we do. But this is what we did after we corresponded with you, Jason. We were thinking, oh, we need to raise these rates, 1 or 2%. I'm like, well, I'm not going to assume 7% increases. If that's the case, everybody in the world is going to come work in Charlottesville. And by the way, Charlottesville is going to go out of business because you can't afford to give that kind of raise. But this is where we are with the recommendations. And, I guess think about that, how that fits. If you got a 5-year plan or a 10-year plan, maybe, tell us if we're okay or if we're off base. Because it does affect the liability only for the active employees, obviously. Retirees and terminated doesn't matter.
Mm-hmm. Yeah, I mean, I guess I would propose for the commission to consider that, like you said, a majority of those increases were one-time increases. And, in the coming year, there's no general cost of living increase proposed. I guess I'd be hesitant to make changes because it feels like the experience over the last 5 years was sort of a one-time experience, but I don't know what other people think about this change to the sliding scale.
Jason Scott here. Is there any data that we can use to validate the argument you just made? It was kind of a one-time thing. There should be something that we could look to, right? Some sort of wage data or.
Yeah, I'm sure. I don't know if budget or HR has, year over year what the changes were, or if we gave that. I'm assuming we gave that to Bill.
Yeah, we have the actual data for every year.
Uh-huh.
Did you note a spike in any particular year there? It seems like that might be something to look for. And
I'm just looking at the impact on the total liability for pension. I don't know if you can see my screen or not. I think you have to reshare it. But when we were looking at the salary increases, it only added about $2 million to the total liability. For what that's worth. Doesn't mean we shouldn't, if you think we should go back, we should go back. But at the end of the day, it wasn't a huge driver of the liability. Now I'm trying to find my screen. I'm not sure what are you looking at? Can you still see the PowerPoint?
Yeah.
Mm-hmm. Percentages.
Okay, there we are. But it wasn't a big number in liability. So even if we changed it back, it still wouldn't, the answers would be a little bit lower, but not dramatically lower.
The other thing to consider on this is, don't forget, we adjust it every year based on experience. So it does self-correct. You just get gains and losses. So for example, between 2018 and 2019, payroll increases added additional $2.3 million over expected. And then 2017 to 2018, it added $1.3 million extra liability. So you do get the impact. It does flow through every year on increased liability. So the issue is, do you anticipate higher increases and not get them, or vice versa? So it does correct every year. It's just this is just a means to try to get better what we expect versus taking those losses and gains.
Yeah, we actually use actual pay every year, so.
I'm kind of with Jason, though. I do think we've had a lot of one-offs. I mean, from a city perspective, it's basically been COLAs, but we have had a tremendous amount of turnover in high management positions, and largely all of those have been rehired at largely higher rates than previous people in those positions. So I do think they are one-offs in a lot of ways.
But that's not measured here. This is strictly year to year of the same individual. So if somebody terminated and you hired somebody else, and they got a 10% raise, that doesn't flow through here. So this is individual by individual's actual pay raises. That make sense?
It does, except I'm not sure. I guess I'm just confused of how we've gotten such a high. If that's the case, I'm confused of where all the increases are, other than public safety, because public safety did get a 9% increase from 18 to 19, no, 19 to 20, but that's not in here either, right?
No, not if it happened in this year since last July.
So I guess I'm confused.
Well, I thought that
we actually ran the data by individual, and we could actually see the increases by year per individual. And there, I mean, it's all over the place. But on total, I mean, it has been much larger than anticipated. So we can, if you want to see something like that, we can provide that because it's already done. But yeah, this is just measuring year to year change in individual salaries. So those new hires don't flow through on this salary increase. They flow through on total liability on payroll growth, but this is measuring strictly individual increases year to year.
I'd be curious to see it because I mean, I think from a large scale, it's been COLAs only, other than the public safety one. So I'm not doubting it. I don't mean to sound like I am. I'm just surprised, I guess is a better word.
Yeah, we have that already out on an output file, so we can provide that for you.
Yeah, Christy, I guess I'm thinking that the 9% public safety adjustment, and then general employees got a 4.17% adjustment. And the council did all the living wage things, and a lot of those employees are in the pension plan. And those were, far in excess of, this 2 or 3% that we would normally be assuming. I feel like that was 2 years ago and would be included in this data. If it's not, then we definitely need to change this because it's coming. But if it is, I feel like most of those were one-time increases that we're not going to see again.
Yeah. So is that in here? Because is the 20 increase in here?
The 20 increase isn't, because we don't have data for 20.
I thought that was 2 years ago.
Yeah, the public safety and the things Jason just mentioned should be in here.
So was that, that was the 18 to 19 budget?
I believe so, right, Jason? I can look.
I can look too.
I thought that happened in 19, and then at the end of the year is when we allocated the funds from the surplus.
We did. The 1.8, you're right. That's right. That is exactly what it is. You're exactly right. The 1.8 was with the 19 year end. So the 4.17 and the 9% would have been from 18 to 19, which would be in here, right?
Right. So they're seeing those payroll increases, but they haven't seen the one-time contribution that we made because that happened in the current fiscal year.
That's right. That's right. And so, but that would have been a one-off. I mean, those two increases, while they're in here, it goes back to your original point, that is sort of a one-time thing.
That's what I'm trying to argue. Yeah.
Yeah, I agree with you. Yeah, I agree with you.
Oh, maybe the answer is, we stick with the rates before and not change them, again. I mean, again, it's up to you. It's gonna fix itself, like Dan said, over time. You know, if we assume people at age 25 are going to get a 4% raise and they get a 2% raise, then we do next year's valuation, you can have a little bit of a gain, right? So that'll work to your advantage. But if that's really going to happen, there's no point raising them from 4 to 4.5, right? I think we can go either way. We just looked at the raw data, and this is one of those things we have to get input. This and how you're going to invest your money are things that we don't control, right? So it's kind of hard to argue with the terminations and the deaths and things like that. But when you've got a plan to say, well, we fixed everybody's pay, from now on it's going to be cost of living or cost of living plus, 50 basis points or whatever. Well, then if that's the case, the answer isn't 5.5%. So you probably just need to let us go how you come down on that. I don't think we have any issue with taking your input.
We look at the actual data for general employees. Each of the last 5 years, like 5%, 4%, 5%, 6%, 7%. That's each of the 5 years. That's for general. For public safety, we had 5%, 3.25%, 13%, 4%, and 8%.
Mm-hmm.
So that, if you just looked at basically on the numbers, you'd be increasing the rates by 2%, which is ridiculous. But that's why we decided just to go with a 50% increase and see how it works out over the next 5 years.
Those are some substantial increases.
Like I said, we can send you, Jason, we can send you guys the data file we have, the historical salaries, so you can see each person and all the changes we've got. Hopefully there's nothing wrong with the data we got. That would not be a good thing, but we'll show everybody's pay for the debt that was reported for the last 5 years. We don't need to decide on all, you guys meet every month, right? We don't need to decide on all this today. We just need to know what to do when we actually sit down and start to do the evaluation.
Uh-huh.
Yeah, I think it would be good to get that information just so that we have a better understanding of it. But I'm also thinking about, we have a comp plan, in the works sometime over the next few months or a year or so. And then how we actually implement that over time, obviously it's going to take, there's going to be some adjustments. So I think it'd be good to understand the past in order to, as we look towards the comp plan in the future, we'll obviously need to then make some additional refinements. But I think it'd be good to understand the numbers over the last few years.
Were there any other assumptions that you think we need to look at in more detail?
From our perspective, I don't think so, other than the investment return. And so the public plans we work with are anywhere from 7 to 7.5%. That's their investment. So you're at the top end, but you're not. We don't have any 8s anymore. Oh no, we do have.
Yeah, we do. I was gonna say yes, we do. We have one that's still at 8%. Don't
have one at 8 because their advisors telling them they should be getting 9 or 10% long term. We're like, no, but all right. But what are you gonna do? So all we do is say, they picked the 8. We didn't. I can't do anything more than that.
I personally don't have any issue with the 7.5%, but you should really talk to your investment advisor about that.
Yeah, we'll definitely do that. Well, I guess, if we're trying to make a decision today on these, my opinion would be to adopt all of the proposed recommended changes except for the salary rate change.
And what are those changes? again?
That'd be the changes to the mortality table and the termination, retirement rates, all that stuff.
Yeah, retirement rates, termination rates, mortality table, some of the medical trends. Those are high level. It's all in the report, actually in the back of the report. You know, look at it all. We have like for each things like the retirement rates, we show what we're currently assuming, what we're proposing for general and public safety. You know, termination of employment, both salary increases. That's the last page I have on here on those rates that are changing.
Jason, do we have to make a decision today? This is Letitia.
No, so you would need it, I guess, you're going to start working on this in August. So we would definitely need to make a decision today or next month's meeting if we
I mean,
haven't.
it's a lot to digest, and I don't know about the other members on the commission. I just would like to review the PowerPoint a little more.
Jason, you sent this out, didn't you?
Yeah, I think it just went out yesterday though.
Yeah, it went out yesterday.
No, I don't think I got it.
It came from Sarah.
Still don't think I got it.
Sarah Butler sent it yesterday at 11:30.
I'll make sure it gets to your new email, David.
Thanks, I appreciate that.
When's your next meeting? 22nd of July?
Should be.
Yeah, I mean, if you want to defer to then and you want us to call into that meeting in case there are additional questions, we can certainly do that. It's easy to go to meetings nowadays. All you gotta do is click a mouse. Dan's actually in Houston, so he probably wouldn't have come had we been in person.
Okay. Well, it sounds like at this point, there aren't any major objections to anything, so. All right, well, did anyone else have any other questions for Sageview? Okay. All right. Well, thank you all very much. I don't think is there any other business, or else we can entertain a motion to adjourn?
Well, I'll make a motion to adjourn.
Okay.
I'll second that.
All right. All in favor of adjourning the meeting?
All right.
All right.
Hi,
All right. Thank you, everybody.
thank you.
Thank you.
Thank you for the additional time.
You're welcome.